Welcome to this video. Today let us look at various risks that are involved in international trade through a case study. Let us assume that a German renewable energy company, SolarTech, is contracting with a Chinese manufacturer, SunPower, to supply 15 million worth of solar panels for a new solar farm in Bavaria. The delivery is scheduled for late April 25. Shipment is via ocean flight from Shanghai to Hamburg. This transaction occurs amid rising U.S. China tensions, EU sustainability regulations, and global supply chain challenges. Given this scenario, what type of contract we will have, what risks we face, who are the parties who play different roles to mitigate the risk, and what safeguard the buyer and seller has to keep in mind. Let us explore. Who are the involved parties? Exporter is SunPower China, manufacturer of solar panel. Importer is SolarTech Germany, purchaser and user of the panels in the farm. Freight forwarder is Euro Logistics, who will coordinate shipment from Shanghai to Hamburg and ensure the compliance with customs. The customs authority, the Chinese customs service, and the German customs authority, who oversee whether the goods are suitable for import and export from various regulatory angles. The banks involved are the Deutsche Bank Germany, who is a buyer's bank, who facilitates payment via letter of credit. Insurer is Allianz Germany, who is the cargo insurance provider from Europe. These are the various entities. Let us look at the various risks. The most important risk is the geopolitical risk. What is it? The U.S. China tensions are escalating. U.S. is threatening 60% plus tariffs on Chinese goods, including solar panels, which is a green energy. This does not directly affect Europe, and Europe is protecting or encouraging green energy, but it prompts China to redirect the exports to Europe. So, the quantity, quality and other aspects of what China is trying to do is an important concern for Europe. Flooding the market is risking Europe. So anti-dumping has to be taken care by the entities in Europe. So what Europe will do? Europe had announced an investigation into the Chinese solar panel subsidies. Because of that, there is a delay in custom clearance in Hamburg. So SolarTech faces a potential hold on its shipment, which are meant for its solar farm. So it will jeopardize the timeline. How can it be mitigated? So SunPower provides a detailed documentation providing fair pricing, that there is no subsidy and there is no undercutting and there is no dumping impact. But the uncertainty is increasing the cost and causing delay in the shipment. This is a geopolitical angle. Then let us look at the logistics angle. From a logistics angle, how the attacks on the Red Sea is disrupting the Suez Canal route. So, Euro Logistics Company is rerouting the shipment through Cape of Good Hope. Also, there is a drought in Panama Canal capacity. So, this route is not used. So, this causes an impact on the shipping cost, which is again passed on to the supplier, which the supplier will have to pass on to the buyer. Then another issue is that the detour will cause 10 days delay, additional fuel, additional costs of labor. And then if there is a storm of the South Africa peninsula, it will also damage the panel due to humidity, etc. The mitigation is that Allianz Insurance is covering the damage and SolarTech is ensuring the delay, and thereby it is helping the goods to be shipped. Now what is happening is the government subsidy deadline is there for the timely reaching of the goods, and it will cost 500,000 if the incentives are to be lost. Let us look at other risk like a currency. Now the transaction is denominated in euro. SunPower's costs are in Chinese yuan. The US dollar is strengthening. Now between the contract signing date, which is a euro Chinese yuan maybe 7.8, and the payment due date, on that day the euro Chinese yuan is 7.5. So if the renminbi moves between 7.8 and 7.5, SunPower is potentially losing 300,000 euro of value of unfavorable exchange shift. For this, they can enter into a forward contract. But they did not. Why? They are assuming stability in euro, instability only in dollar. So this is one way of handling the risk. What you believe or what plans you have in place. Let us look at the regulatory and compliance risk. Now, EU's carbon border mechanism carbon border adjustment mechanism. It is called CABM. It is supposed to impose carbon tax on importers with high emission footprint. China's coal heavy manufacturing raises the panel's carbon cost because China is using electricity to manufacture the panel. That electricity is coming from coal, and so there will be a higher cost because of the carbon tax. Also, the shipment is coming through a longer route, then it will have a higher carbon cost. German customs levy unexpected $200 or 200,000 euro, for example, carbon fee, which SolarTech must pay. Why? Because the contract is so structured. SunPower faces reputational risk as a high emission supplier. SunPower is facing a reputation risk. Solar Power is facing an additional cost risk because of this import. The mitigation is that one has to adapt and adopt cleaner production methods and then share the CABM cost in future contracts to 50-50. That is one way of handling this compliance and regulatory risk. There is also market risk. Market risk is that the China's export is pivoting to oversupply Europe. So this will cause a cheaper solar panel availability. Its prices are dropping. So if you have already entered into a contract with a price and prices are further dropping, then it is good for the Chinese entity and not so good for the German entity who is importing. So what one will have to take care, there is a potential loss for the SolarTech in the market value before installation. This will reduce the project profitability potentially as an opportunity cost. So SolarTech would have locked in a resale price or diversified supplier from Vietnam, etc. But long-term contracts limited this flexibility. Why? Because of the dropping prices due to certain geopolitical reasons. So these are the various risks one will encounter in a cross-border trade. The credit and payment risk is that SolarTech is using a letter of credit from Deutsche Bank payable upon delivery. But EU unification and shipping delays raises doubts about timely payment. Why? Because EU may find the goods not fitting their CABM framework. SunPower is shipping the goods but faces a 30-day payment delay because SolarTech disputes the damaged goods because of the roundabout route and the storm. SunPower's cash flow tightens. This is risking their payments to their suppliers. What is the mitigation? A better Incoterm, CIF, could have been used instead of FOB. Then this would have shifted the risk, but both the parties are underestimated the delays. Why? If it is CIF, then the moment the goods are put on board and insurance and freight is taken care, it would have been easier for the party and the delay would not be responsible on the supplier. Right? What is the outcome? The outcome is 45 days of transport time originally planned was 30 days. 15 million amount was paid for CABM case. 1.25 million additional cost incurred. 1.5 million additional cost, 25 additional cost was incurred or in the form of lost subsidies or delays or damaged goods. So net SunPower gets a 14.7 million after currency losses. Relationships with SolarTech also strained. The deal is completed, but parties have reason to revisit the future trade due to the higher risk that they encountered in this particular situation. Many things could have been done better, but they didn't do. The insight is that there is interconnectedness in everything. Geopolitical shift or a US tariff or a Chinese excess supply, and everything will affect an European trade. This is a ripple effect of the global interconnectedness of the trade. Then comes the unpredictability, the environment or a regulatory risk or the storms or a CABM interpretation. This will amplify the cost. And if there is a delay in shipment route, it will reduce the subsidy or incentive. Then comes the financial exposure, the currency movement. As you have seen in this example, 7.3, 7.5, 7.8, etc. Then comes a payment risk. Even though there is an LC, there could be other discrepancies of non-compliance. They will erode the margins. And though without helping, it will be difficult. If you hedge, you have to pay for premium. Then there is a need for adaptation. Diversifying the suppliers and diversifying the routes. These two the people did not do, which cost them little higher. So the conclusion is that there are multifaceted risks in international trade. We can call it as geopolitical, logistic, regulatory, financial, market driven. this will converge into a single transaction. One wrong thing at a time, together at the end of the day, will cause a loss of financial incentives that a company is expecting to do in the trade. This is caused because of the global tensions, climate challenges, policy shifts, political reasons. So traders or buyers and sellers need to adopt robust risk management strategies in the form of adequate insurance or hedges or contractual terms so that the trade can be conducted successfully. Thanks for watching this video.